G'day everyone, Greg Canavan from Rum Rebellion here with another stock market update for you. Today I'm going to talk about the big topic that's obviously making a lot of headlines at the moment, and that's the banks and the Royal Commission. Recording this at about 11 o'clock on Tuesday morning, so the market's been open for an hour or so, and the banks are rallying very strongly. And that's really got to do with the fact that the Hayne report from the Royal Commission has gone pretty easy on the banks. It's made no real recommendations that are going to change the structure of the industry, and that means the banks will continue to make plenty of money from selling mortgages and the like. The other thing to note is that leading into the report's release on Monday afternoon, bank stocks had fallen quite heavily. The sector itself was down about 16–17% since the Royal Commission started in February last year. So we've already seen a lot of negativity factored into the share prices. What you're seeing today, some of the banks are up as much as 5%. I think what you're seeing is a lot of short covering. I think a lot of hedge funds and various investors probably position themselves for a more negative report than what we actually saw. And when that didn't come to pass, you're seeing a lot of those players who place negative bets buying shares back to get out of that trade. So what I want to do is just run through the big four bank share prices, try to put things in a bit of perspective. I know on days like today when there's a lot of headlines, share prices are moving quite strongly. It brings out a lot of emotion. So it's best to take a step back and look and see where we are in the bigger picture. So let's do that first with a chart of the Commonwealth Bank. Before I start, probably worth pointing out that all the charts I'm showing you today, they don't have today's intraday data, so they're not showing today's big moves, but I'll point out where some of the stock prices are sitting at the moment as we go along. All right, so let's start with Commonwealth Bank. That's probably been the strongest bank in terms of how the chart looks. It's probably been the strongest bank of all the big four. This morning's rally has brought it back up to around $73. It's sitting just near where the January highs are. So if it can break out to new highs in the next couple of days, that'll be quite bullish, and it'll point to a change of trend. Often the Commonwealth Bank is the biggest and probably the most well managed of the big four banks, and often that leads any change in sentiment in the sector. So if Commonwealth Bank does break out to new highs, it could just reflect that there is a sentiment change in the banking sector, and we might be moving towards at least a medium-term or short-term trading opportunity in the banks. So Commonwealth Bank looks quite good. As you can see, the moving averages crossed over to the upside during January, reflecting the fact that the low was made back in October, and the stock price has been working its way steadily higher since then. Moving on to the next chart, we've got ANZ Bank. Once again, that stock price has rallied quite strongly today. Not sure where it's obviously going to finish the day's trading, but at the moment in early morning trade, that's actually trading at new highs in terms of beating its January high. But as you can see, unlike the Commonwealth Bank, it only made a low in December, so it's still got a bit more work to do before we can sort of become a bit more confident that the trend is changing there for ANZ. Similar story with National Australia Bank. You probably heard this bank, out of all the big four, copped it the most in terms of, I guess, a cultural caning by the Hayne report. He sort of singled out the CEO, Andrew Thorburn, and the chairman, Ken Henry, and sort of pretty much pointed out that the NAB's cultural, the culture of the NAB wasn't great, and had reservations of whether that could be improved. So that's why the NAB share price looks quite weak. It's had a bounce since December low. And it's still trading. This morning it's had a good rally, but it's still trading below $25, which is the January high there. So out of all the four, NAB's probably looking the weakest. Moving on to Westpac, similar story to the other three there. December low, rallied strongly in January and then sold off again. Once again though, like all the other four banks, that's rallied strongly this morning, trading up around the $26 mark, which is just below the January high. So out of the big four banks, technically the Commonwealth looks the strongest. ANZ's also got a mention there for trading above its January high, which could indicate that we're seeing a change of trend. I wrote in the Rum Rebellion yesterday that we could be seeing the emergence of a buying opportunity for the banks. For longer term buyers, I think it's still too early to tell. Apart from the Commonwealth Bank, all the share prices are still trending lower, and you probably want to see a bit more, another month or two of share price action before you get more comfortable that the final lows are in. The other point to note there, there's still fundamentally many headwinds for the banks. I mean, you've got slowing housing construction, slowing apartment construction, and the Royal Commission did put a lot of pressure on the banks to curb their credit expansion, to curb their lending. So all those things will weigh on the banks. So today we've had a big rally, which is fine, but a lot of that is short covering. So you really need to step back and see how trading plays out over the next week or so to get a feel for how the market is really judging these banks at the moment. So I'd sort of not necessarily ignore today's moves, but take it with a grain of salt, given that there was a lot of positioning around the Royal Commission built in, and you're seeing a lot of change of that positioning happening today. Right, moving on to the broader market. A couple of weeks ago in one of these Rum Rebellion updates, I pointed out how the strength of the rally would probably turn down at some point. Clearly I was wrong there. The rally has probably surprised not just me, but a lot of other people over its strength and persistence, and we really haven't seen much of a pullback since the rally started at the end of December around Christmas time. What's going on? I think the biggest impact in the market over the past month or so has been the US Federal Reserve easing back on its commitment to keep raising interest rates. I think it's pretty clear that we're at the sort of top of the cycle in terms of the global business cycle, and the market was pricing in a Fed error in that if it kept raising rates in the face of a slowing business cycle, then that was going to cause quite a few problems and quite a hit to company earnings. The fact that the Fed has now taken a step back and said that it's going to be data dependent and it won't be raising rates as fast as what it had previously indicated, I think that's a pretty bullish sign for the market, and it's certainly why that the market has refused to sell off and is holding these highs. Once again, the chart of the ASX 200 here doesn't show today's move, but it's popped higher again on the back of the rally from the banks, moving above its 200-day moving average, which is the red line there. So that's a bullish sign for the banks. But once again, overall, if you look at the trend, you've got the 50-day moving average, the blue line, well below the 200-day moving average, the red line, which is a very shorthand indicator of the fact that we're still in a downtrend. Further to that, we're still well off the highs. And I guess my interpretation of this chart is that while you're seeing a big shift from the bearishness that we saw at the end of 2018 into bullishness now, I think once enough people move over into the bullish camp, you'll still see a decent sell-off eventuate. Whether that happens next week or next month, I've got no idea. But the thing to look out for is where the support comes in after that sell-off, and we'll get a better idea of that when it actually happens. The Nasdaq is showing a similar sign. Once again, you saw a big sell-off into December, broke through some pretty major support levels, but easily enough, once the market realized that the Fed was going to be, pulling back on the interest rate rises, you've got the market moving higher again. Similar story to the ASX 200 in that the index is still well below its highs, still in a downtrend in terms of the moving averages there. And whether this has got any more legs, this rally or not, I've got no idea. But I do think once you see enough investors move over into the bullish camp, there's not going to be any more people to buy and keep pushing stock prices higher. And that's when you see negative sentiment kick in. Obviously, there's going to be a catalyst for that, whether that's an earnings downgrade from an important company, whether that's some more news coming out about the US-China trade relationship. I've got no idea. But at some point, you'll get enough people that are bullish, no more people to buy, and then you'll see a sell-off eventuate. Once again, the important thing to look at is where that sell-off finishes and whether we can become more comfortable that the market may be bottoming out here. My view hasn't changed. I think we're in a bear market and a very strange topping out phase made, I guess, more difficult to work out by central banks that have obviously become more interventionist over the years. But that's just something that all investors deal with. And I think the best way to handle it is to let the charts give you some guidance, obviously backed up with some fundamental analysis. All right, let's move on. Couple of interesting charts here that I've been looking at for probably most of 2018 in guiding what's going on in other parts of the world. This is the iShares MSCI Emerging Markets ETF. Emerging markets were under all sorts of pressure in 2018, but interestingly enough, they bottomed in October, rallied, made another low just above that October low in December. Now, if you think about what was happening in the more developed world markets, you saw US stocks, Aussie stocks all form new lows in December, but this one, the emerging markets actually outperformed, and now you're seeing a bit of a rally, and we could be seeing a change in trend here for emerging markets, which is going to be bullish or is a bullish sign for the global economy. And it's also goes back to what I was saying about the Federal Reserve. When the Federal Reserve's tightening interest rates, the US dollar's strong. When the US dollar's strong, it puts a lot of pressure on emerging markets because a lot of those companies in emerging markets have borrowed in US dollars and increased their borrowing cost, puts pressure on equity markets. So what you're seeing here with this potential turnaround in emerging markets is saying that the liquidity tightness that the emerging markets were worried about in 2018 isn't as much of an issue now, and that could be a bullish sign for markets in 2019. So putting all this together, I'm probably not as bearish as I once was, because there's evidence to show that liquidity is becoming a little easier in other parts of the world, and that's something I'll certainly be keeping in mind as I continue to evaluate the markets. One more market just to reinforce that. This is the Hang Seng Index, which is the Hong Kong stock market. Got a lot of Chinese stocks and a lot of international investors invest in China this way, just with ease of getting money in and out and the liquidity characteristics of the Hang Seng versus the Chinese stock market. This is a similar type of chart to the emerging markets chart, in that you saw a low form in October. The stock market rallied, came back down, formed another low in late December, early January, and is now pushing higher. So once again, that's a bullish sign for global liquidity. And it also tells you that perhaps the market's not as concerned as what the headlines are suggesting in terms of the global trade situation. Hong Kong, obviously a very trade exposed economy in relation to China and US trade, and the fact that that's rallying gives you a bit of comfort that maybe the trade picture there won't be as bad as what some of the headlines suggest. But it all comes back to the liquidity angle, and that comes back to the Fed being easier than what many people expected. The flow-on effect to that obviously is stronger precious metals prices. So we've got the gold price here. One interesting thing about this chart that I highlighted to my subscribers of Crisis and Opportunity last week, just the fact of the different support levels there. And in late 2018, the rally in the gold prices has almost been the mirror opposite of the downtrend that you saw at the start of the year. So the three support lines that I've ruled there, they've acted as support during November and December rally and into January 2019. And in the downtrend over in June and July, those support levels were broken quite easily as gold prices fell sharply. So I think what you're seeing here in gold, very, very strong move from long time lows. You can see the moving averages have turned to the upside there. Gold's done quite well in getting very quickly to about 13.30 an ounce. And you're going to see pullbacks along the way, as you saw during January there. But I think gold can get pretty quickly up to the 13.60 level. There is a lot of resistance around there, so you might see a bit of profit taking and a pullback once you get to there. But if we break through 13.60 to 13.80 and into clear territory, I certainly think gold prices are going to go back to their all-time highs up around $2,000 an ounce, and that might be later in 2019. but certainly if we break through those levels, very bullish for gold and gold stocks. And if you get a sense now, most of you probably know that Aussie gold stocks have done very well over the past 12 months, 2 years. They've been in a bull market for quite some time, but US gold stocks haven't done anywhere near as well. So the two charts I want to show you here just to finish up from the US gold indexes. First one is Junior Gold Miners ETF, which is GDXJ. Often in a bull market, the juniors tend to move faster as speculative capital comes into the sector. Whether we're seeing that now or not, I think it's probably a little bit too early to tell. But if you look on that chart, there's a line that I've drawn there. And in August of 2018, the sector broke down below that long-term support, which looked quite ugly at the time. But the selling didn't follow through too strongly. It bottomed out in September, tried to rally back to support, come back down and tested that low in November. And then just recently this year, we've broken through that support that was resistance, and now it's been cleared again, which I think is a very bullish sign. Also, the moving averages have crossed to the upside and acting as support for the junior gold stocks. So that's really bullish for the smaller stocks in the US market. And also we're getting a bit of movement in the big stocks as well. This is the Huey index, which is the Amex Gold Bugs index. Similar story, broke down below long-term support. Didn't break down too badly though. Normally when you get breakdowns like that, they can be, it can be a continuation of a long downward trend and end up quite ugly with significant losses. But after the initial selling, you saw buying support come back in, and just very recently the Huey has broken back above that line of support / resistance. So once again, I think that's a sign that sentiment is starting to turn towards the big gold stocks, and you're also seeing in the junior gold stocks. Once again, goes back to the Fed being more easy now. So the whole bull bear market argument, I think it's very much up in the air at the moment. One thing to keep in mind is that when stocks fall and fall very sharply, sentiment gets very negative and everyone gets over to one side of the boat. That sets the stage up for a strong rally, which we're seeing at the moment. And the question is, how many more people are there to move over to the bullish side of the boat? My guess once again is that I don't think there's too many more to move into that side of the market. So keep your eye out for a sell-off in the weeks to come, and then we'll keep an eye on where that sell-off ends up. Thanks for listening. That's it for today, and I'll catch you again next week. Thank you.